Hello, welcome to the midpoint of 2025. To say that this year so far has been interesting would be an understatement. From the new administration and the agenda that's moving forward to the market volatility as a result of some of those agenda items and many other developments going on, of course, it's been quite a ride so far. The changes that we've seen occurring politically, militarily, economically, are probably on a scale that the US hasn't seen since World War II. Global conflicts, trade, markets, everything has been affected one way or another. And navigating all of that has been quite interesting on the other side of this screen. And somewhat challenging, of course, I'm sure you can understand. Right out of the gate, we've had trade announcements that rattled the markets, pretty high level of uncertainty, and we know that the market dislikes uncertainty. So, not a surprise that we saw market correction starting in February through April. Now, not much of a surprise that we saw a correction. It was just the catalyst. Markets were pretty overvalued. Some of the returns that we've seen in the past couple of years, while we welcome the positive returns, we do need those earnings to go along with it. And so the market, certainly looked overvalued, and a correction, was not really a surprise, a bit overdue. So that push, whether small or in this case very large, certainly caused some volatility to occur. Not that the trade and tariff issues are completely behind us, of course, but we do have more clarity than we did earlier in the year, and hopefully, we can certainly move forward with some of those new deals that have been signed, some investments that look like they're coming, to the United States. Most notably, Japan has announced, or I should say, Japanese companies have announced over $1 trillion of investment into the U.S. So that's exciting. Obviously, it's not all sunshine and rainbows, of course. We did see, as a result of a lot of that uncertainty, that GDP, which is a measure of economic growth, did decline in the first quarter of this year. At the time, we certainly looked like things might be ripe for a recession. Companies were pulling back, shipping volumes declined. Countries obviously were trying to figure out what we were doing over here, and companies, alike. It's certainly difficult to plan when you have the levels of uncertainty that we were seeing back then. The global economy is a big thing. It doesn't turn on a dime, one way or another. So it will take time for all of these changes to be digested, and we can see what that might look like going forward. As of today, it looks like we've turned that around, and we've seen a positive GDP number for the last couple of months. We haven't gotten the second quarter number quite yet, but it does look like we might end up still being positive for the year, although less growth than what we potentially were looking like at the beginning of the year, if that makes sense. So one of the other themes this year has been the Federal Reserve as it relates to interest rates. The Federal Reserve made their last rate cut back in December, and they've been on hold ever since then, analyzing the data, or what we in the business like to call being dovish. And since they are an independent body, despite what we've heard in the news recently, they don't have to listen to anyone, including the current administration. So what the Fed looks to do is keep unemployment low, which it is, and also keep inflation under control. Little bit less success there historically, potentially, because we've seen the uncertainty so far this year with trade and tariff policy, as well as some economic factors. They're definitely waiting and seeing what some of that data looks like. Interest rates are a double-edged sword. If you are a lender, as most investors tend to be, you like to see interest rates higher. You get paid more for the money that you are lending when interest rates are higher. But of course, on the other side of that, if you are a borrower, especially a borrower for larger items like homes and autos, obviously higher interest rates are a drag, on people's ability to do that. So the Fed is going to keep on analyzing the data to decide when they might reduce the interest rates. We will wait and see. Nothing final there yet. Looking ahead for the rest of this year, obviously we keep our ear to the ground with all manner of pieces of information and data out there. Consumer sentiment, how we are all feeling about the economy and the markets has come down. Not a surprise. More uncertainty, more volatility. People are a bit less confident. Recently picked up. June was a pickup in that a little bit. But what we are seeing is that retail sales are lower, vehicle sales are lower, and home sales have declined. So again, higher costs of things, people are pulling back a bit. However, underneath that, restaurant spending is up, wages are up, savings rates are higher, and outstanding credit card debt has seen a little bit of a diminishment as well. So on the other side, if people aren't spending money on the big ticket items, looks like they're just going out to eat a little bit more and saving some money and maybe paying down some debt. So those are not bad things at the household level, but obviously they don't move the economy forward all that robustly. So we will definitely look and keep an eye and see what that portends. Obviously, if we see economic slowdowns or increasing unemployment or other pieces of data that cause us some concern, we will make some additional changes. Having said that, so far this year, with everything, the market seems to be holding its own. At the end of June, the S&P 500 was up just over 5%. Most of that came in June, but we are definitely positive for the year, and we are still lagging the rest of the world, meaning outside the United States, those markets are providing higher rates of return so far this year. That's been a reversal. The U.S. has been leading the way for quite a while, but that is why diversification is important. We want to have allocations not only in the U.S. but outside of the U.S. as well, so we are participating in those good returns as well. On the bond side, we've seen positive bond returns so far this year as well. All things being equal, bonds should be positive as they throw off interest. That is why we hold them. Also for the reduction in the volatility on the stock side of portfolios as well. And they did that job well during the volatile period that we saw in the first quarter too. So obviously we are keeping our ear to the ground there as well. We're still underweight stocks. So this is a theme that we have continued for roughly a year and a half or so. We started in the tech sector, reducing allocations there as we saw the run up from the Magnificent Seven. We've continued to see an overvalued situation in the market, and so we continue to reallocate and be a bit more defensive. More income, more stability, and less equity, less volatility. And obviously we ebb and flow and move in and out of those allocations based on the data that we are seeing. Obviously, we can have a more in-depth conversation. These are at the macro level inside of our portfolios. At the micro level, I'm happy to have conversations about what your risk-return dynamic and your portfolio allocations look like, and whether you may or may not want to make a change. My door is always open, as they say. You can always use the link in this email that you're receiving, or the email you did receive, to get on my calendar, or obviously you can call me at any time, right? So As for myself personally, June was a pretty busy month for the Lido household. My older daughter graduated from high school, so definitely turning the page to the next chapter in my parenting book, if you will. I did manage to sneak away with her and take a vacation. My family has been scuba divers for a very long time, and I did get my daughters certified. So we took a nice trip and did some really nice scuba diving and saw lots of good stuff. So if you're curious about that, I always love talking about those kinds of things. Other than that, I do plan to put out another video here soon on the tax and spending bill that just came out, but obviously that's going to be a little bit more in depth, so I'll need some more time for that. Other than that, I hope you are enjoying your summer and enjoy what is left of it. Thank you for your time as always. Take care. We'll see you soon.